What is DSCR, or debt service coverage ratio? Welcome back to our video series of essential terms that busy professionals need to understand before they start investing. On today's video, we are going to break down what is debt service coverage ratio, how is it calculated, and most importantly, why is it important for you to understand with context to investing. Welcome back to the channel. I'm Dr. Jonny Walker. I'm excited to have you here. I'm a successful endodontist with multiple practices, as well as a self-made multimillionaire in real estate investing. On this channel, we teach dentists and high-income professionals on how they too can achieve financial independence through investing passively in real estate. I created this channel specifically for the busy professional who makes a lot of money, but they don't have the time and the knowledge to go out and learn yet another business on how they can best utilize and put their hard-earned money to work for them. My goal is to deliver the most important and pertinent information in a highly curated fashion. Let's go. What is DSCR? Now, it stands for the debt service coverage ratio. Now, this ratio or this metric is a measure of the cash flow available from a piece of real estate or a business and its ability to pay their current debt obligation, usually with real estate in the form of a mortgage, in business in the form of a loan. So to understand this ratio further, let's take a look at what goes into calculating this metric. The formula is, for debt service coverage ratio, is the net operating income divided by the debt service. Now let's define these terms a little more. I did a whole video on NOI. You can click on the link so you can go back and review what NOI is and why that's important. But basically, a net operating income, to get the net operating income, that means the income generated from the operations of the property. Let's take an apartment building, for example. All the income from an apartment building in the forms of rent and fees is your gross operating rent. This is from running the apartment building. It's going to generate a certain amount of money, and it's going to cost a certain amount of money to run the property, or operating expenses, which include things like utilities, gas, property taxes, property insurance, HR, paying staff. These are all expenses of the property. So you take the gross income, all the rent, minus the expenses, and that gives you your net operating income, or NOI. Now that value, that number, it will give you your NOI. The debt service, on the other hand, is exactly that. When you borrow money to buy real estate, which most people do, that's called leverage. When you leverage and buy real estate, you borrow money from the bank. To borrow money from the bank, you have to make mortgage payments on that loan. Those monthly mortgage payments is your debt service, or monthly debt service obligation. If your monthly debt service obligation times 12 is for the year. So you take your yearly net operating income divided by the total amount of money that you'll have to make in mortgage payments to the lender to arrive at your DSCR, or debt service coverage ratio. It's simply a ratio of income to mortgage payments. Now, why is this important, and how is it important? It's important because it allows lenders, mortgage banks, community banks, any type of lender to know the financial capability of a particular property to pay back its obligations in terms of debt. Now let's take a couple of real life examples. If you were a person lending money, which of these scenarios would you be most comfortable to lend to? Now, say we had a 25 unit apartment building, and after all the expenses, the net operating income for this property is $100,000. That means after the operations of the business, at the end of the year, we've collected $100,000. But we still haven't paid off our lender. Say that the net operating income is $100,000, but the cost of servicing the debt is $100,000. That means we take our full $100,000, give it to the bank, and we've covered our debt obligations for the year. That would have a debt service coverage ratio of 1.0. Now, what happens if our debt service for the year is $120,000 or $10,000 a month, but our income is $100,000? So we're not bringing enough income to service the debt. what happens to the ratio? It goes below 1. It becomes 0.83. Now, say the property generates 100,000, but interest rates are low, or the terms, we've got very favorable terms of our financing, and the debt service only costs $80,000. So now we actually have, in this scenario, we actually have cash left over. What happens to the ratio? That debt service coverage ratio is 1.25. It's above 1 when the amount of money exceeds how much money we need to cover our debt. Let's look at another example. Say that it only costs us $35,000 to finance this property. In this scenario, now we're still making $100,000 off the property, but the cost of our debt is only $35,000. In this scenario, the ratio is 2.86. Now, if you were the lender and you were like, hey, look, I'll lend you money to buy this property, which ratio are you most comfortable to lend on? In a ratio where the property's making less money than they gotta pay you, or where they're making almost 3 times the money that they need to pay you? In this scenario, the lender feels very comfortable. They feel warm and bubbly, and they're more likely to lend you as much money as you want. In the world of multifamily real estate, the minimum ratio, and even in a lot of residential homes, a lender wants to see a ratio of at least 1.25 or greater. This gives them a little bit more feeling, the warm, fuzzy feeling that, hey, this property can still pay off the loan. Even if economic conditions changed in a disfavorable manner and the income from this property went down a little bit, the ratio would go down, but they would still feel comfortable that even if it were to decline by 10%, that this property would still be able to make its monthly obligations. Whereas in a case where it's 1, where all the money is going completely to the lender, what happens if the income goes down by 10%? Another event happens which drives rents down. Now you're only bringing in $90,000 of income, net operating income, and you gotta still make a $100,000 payment to your lender. Now all of a sudden, you're in a negative cash flow territory and the property cannot sustain the debt obligation. So, ratio under 1 signifies major problems. This property has major negative cash flow. Maybe that's part of the plan. Maybe you're buying a property that needs to be rehabbed and renovated so you can bring rents up. But until you bring rents up, it's gonna be in a negative cash flow or a debt service coverage ratio of under 1. This sends off red flags to lenders because they're like, I don't know if I want to lend on something. This looks a little speculative, looks a little dangerous. So as you can see, this ratio is of most important, especially from a lending standpoint, as well as an underwriting standpoint if you are going to be investing in this property, because you want to be able to understand, will the proceeds of this property be able comfortably pay off your mortgage obligations? All right, guys, that's the video for today. Hope you got a ton of value from it. Now, if you are interested in investing alongside us in low-risk cash-flowing assets across the United States, click on our website in the description below. You'll be prompted there to join our Passive Investor Club. In this exclusive club, you'll get exclusive content as well as access to our latest real estate opportunities once you have booked a call with us, so that we can gain a little bit more information about you and see if we're a mutually good fit. Again, the Passive Investor Club is totally free. It's only open to accredited investors at current. Go to the website to learn more. Now, if you enjoyed this video or enjoying this channel, make sure you smash the like button, share this video with your colleagues, and I'll see you right over here on the next video so we can continue our walk of wealth together. Let's go, guys.